At the New Jersey SBDC Network, our mission is simple: to help businesses grow and succeed. Our consulting, training, and information services make it easier for businesses to reach their potential. Whether you're currently in operation or just starting out, we have the right tools, resources, and expertise to help you succeed. Visit us online to get started on your path to success today.
A pleasant good afternoon to everyone. My name is Sakoa Bell. I am an event coordinator here for the Rutgers-Newark SBDC. And on behalf of Dr. Tendai Enduro, the regional director, I would like to welcome you all to our Taking Control of Your Company Finances webinar, For those of you here that are unfamiliar with the SBDC, it stands for Small Business Development Centers. And here at the New Jersey Small Business Development Centers at Rutgers-Newark, we serve as the premier provider of business training and technical assistance services to established small businesses, startups, and entrepreneurs. We are one of 12 centers in the NJSPDC network, and we service those in Essex County. Our center here is hosted by the Rutgers Business School and funded through a public-private partnership between Small Business Administration, Rutgers University, and the New Jersey Business Action Center. Now, our mission here is to help entrepreneurs as well as business owners start and grow sustainable, successful businesses through the delivery of one-on-one business consulting, training, and technical assistance programs. Now, these services are provided to you at no cost and are paid for by your tax dollars. If you or your business is located in Essex County, our website is www.rnsbdc.com, where you can request counseling. And on the top right-hand corner of our site is a button labeled Request Counseling. So clicking on that button will lead you to fill out information, including the help you are seeking with your business. And within 24 to 48 hours, a consultant will reach out to you for an assessment. So for those of you that are not in Essex County, our other website is www.njsbdc.com. And on this website, you can type in your county and it will refer you to your local SBDC office. For the benefit of everyone attending today's webinar, your audio has been muted and we will be taking questions via the Q&A feature here on Zoom. We do have the chat feature on, but the Q&A feature will help us to remain organized and have the questions and answers in one designated area. So please feel free to post your questions and we will do our best to respond during or at the end of the webinar. A copy of the presentation slides, along with a video recording of this webinar, will be emailed to you within 48 to 72 business hours, so that you can refer to this information and the replay long after the end of this webinar. So it is now my pleasure to introduce to you all Mary Baker. She is the presenter for today's presentation. So Mary is the CEO and owner of Baker Tax and Accounting Services, LLC, and is an SBDC consultant here at the NJSBDC at Rutgers-Newark in the areas of taxes, accounting, bookkeeping, and financial management. Now, without further ado, I will now turn today's presentation over to Mary.
Hello, everyone. Good afternoon. Thank you all. Good afternoon, first of all, on this cold, very cold day in New Jersey. So first, I would like to thank each and every one of you for attending this webinar today. It is a pleasure to have you on today and just to join you today and share information with you today. I also want to thank Rutgers for having me today and just educating you all on getting your company finances in order. We know during this time in the last year, it has been very important for us as business owners to just take control of our company finances, to know what's going on with them, to plan out for the new year of 2021, which time is the best time now. We know last year it has forced all of us or most of us to shift how we do business. And what time, but the best time is the beginning of the year, January, to plan out the rest of the year um, during these challenging times for business owners during COVID. So today we are going to go over some of the numbers that are very important in your business and how you plan the business. These are numbers you need to know about, to learn about, um, that has a major impact on your business. And if you do not handle your company's finances, this would also, you can go back, ask your accountant about some of these numbers, what are your ratios, things like that, so that you can plan your business numbers going forward in the year. The next screen. So today what we're going to talk about, the next screen, the agenda for today is we're going to talk about why is it important to know your business finances. Why it's important to know these numbers. Not only it's important for you as a business owner to know these numbers, but it's also important for you when you are applying for, if you apply for grants, business loans, things like that, to know your numbers. We will also go over cash flow. What is cash flow? And so I know most of us last year and continually now is probably experiencing some type of cash flow depending on the business you are in. So but now is the best time to learn about cash flow and understand it. We're going to learn about what are some of the major problems that causes cash flow problems in a business. We will also look at a cash flow statement to understand what that means. We are also going to look at a profit and loss statement. We are going to go over some of the major business finance ratios that you should know about your business and the plan for your business coming to 2021 year. And also we have questions and answers. We ask you to hold those until the end and we will answer them. If there is any question that I do not know or have the answer to, I will get that answer and make sure that you get the proper answer for that as well. So let's get started on why is it important. So I love this quote from our famous person, which we all know is Bill Gates. And what Bill Gates said, I have been struck again and again by how important measurements is to improving the human condition. And so measurements would mean numbers. How do we know what are the numbers? How important it is to know the numbers in our business to improve the condition in our business as well as our human conditions. Next. Okay. You need to know as if you're running a business, and so let's be candid here. Most people, we start a business, some of us has business plans, some of us has a passion, but we really need to think about how important it is to know the finances in our business. Business finance is one of the first major thing you should know as a business owner is understanding it. Even if you do not do your books or you have an accountant or bookkeeper that handles your books, you should be able to have a conversation with that accountant or that bookkeeper and go over your numbers and understand what's going in your business. If you have a product or if you have a service, do I need to go up? Do I need to go down? If I'm trying to reach a financial goal, what is that goal and what should I be doing with that goal? So you should always know your business finance. Business finance is the art of managing your company's money. And so even though if you don't handle your company's money and someone else is handling it, you need to understand the numbers and how you want to manage it to reach your goals. The role of a finances business is always to make sure that there is enough funds, enough money to operate, and that you're spending and investing wisely in your company. You want to make sure that you're always in the positive to operate your business. If you are in the negative, you should go back, look at it, and see what's causing the negative. The importance of business finance lies in its capacity to keep a business operating smoothly without running out of cash, while also securing funds for longer term investment. So a lot of people always ask me, where do I start? I'm running a business. How do I know how much I need to have, how much funds I need to have to run my business? So the main thing here is you need to start with some type of budget. I always tell a business owner, when you're starting your business budget, also include your personal budget, your household budget. How much is your mortgage, how much your electricity, how much it costs to run your household as well. Because as a business owner, if your personal finance is not in order, your business finance will not be in order. So it is so important when you're creating this business budget to always include your personal budget in there as well, because your business needs to show a profit, you need to pay yourself, and you need this money just to run. Okay, thank you. Next. So financially, historical focus in running a business in your finance. If you want to measure your outcome, you need to focus on your revenue. You need to focus on your expenses, which equals your profit, right? So I always say in this formula, they always teach us revenue minus expenses equal profit. But we also need to put in there some money in there for us, our financial, right? So it should be revenue, it should be expenses, and it should also minus, as I said previously, your household budget. You should always have that included. And if you do include your household finance, your bottom line, your outcome will show that your business made a profit. Nowadays and going forward, it is so beneficial for you whenever you're trying to seek any type of funding. We can tell this from the PPP and all of these other things, that we need to show some type of profit in the business, even if you're getting a business loan. Old school, we did not, because we didn't want to show taxes, but you need to show some type of profit, or if you're in a business and not treating it as a hobby. Okay, great. Thank you. So the main three goals that you need to understand, and the three major statements that you need to understand when you're running a business, is the income statement, which I'm quite sure if you're applying for a loan or if you're applying for grants or anything, most people want to see your income statement. You have a statement of cash flow, which we will go into, and then you have a balance sheet statement, which is very important as well. So the income statement, it shows you to sell your goods and service for more than it's cost to you to provide that good or service, right? So you want to sell whatever you're selling, right? You should sell it for more than it costs you to provide the service or to provide the product or good. The income statement, bottom line, gives you what we call your net income. So your net income, you could look at this as your profit, your bottom line on what your company actually is making at the end of the day. You can run this statement monthly, you can run this statement quarterly, or at the end of the year. I say minimum, look at this statement on a quarterly basis when you're running this statement. Okay, I apologize. So the next statement is the statement of cash flow. And the statement of cash flow, it maintains a healthy, it shows you what is your cash flow, what is you currently have on hand that is keeping your company running, right? What is currently, how much money do you have on hand? What is your cash flow to keep your company operating on a day-to-day basis? And the bottom line for the statement of cash flow is your operating cash flow. It is your operating, how are you operating on the cash flow? And the third statement, which is very important, is your balance sheet. And your balance sheet gives you to get a return on your in total investment of the company. Return on assets will give you the results of the balance sheet. Okay, next. What is cash flow? So let's ask this question. What is cash flow? What does that mean? When someone say, what's your cash flow? Do you know what the cash flow is in your business? Cash flow is the money that is moving, flowing in and out of your business on a day-to-day basis to operate on your business. What is it like? How much you have on hand? Can you purchase whatever you need to purchase? Can you pay your employees on time? That's what cash flow is. Cash is coming in from customers or clients who are buying your product or services, right? That's what cash flow is. Cash is going out of your business in the form of payment for expenses. You're paying your rent, you're paying your mortgage, you're paying your employee, you're paying for cost of goods sold, you're paying all of that. So cash flow is the money that is moving in and out of your business on a daily basis. It is so important that you understand and know what your cash flow is. Next. There are these are listed as some of the major issues that cause cash flow problems. And I'm quite sure some of us, a majority of business owners, experienced this last year with the COVID pandemic, with the cash flow when people just stopped shopping, people stopped coming out of the house, people stopped using our services, things like that. So some of the major issues of cash flow is you're not having enough cash reserve, right? Normally, as a business owner, we never thought about having a year's worth of cash reserve. We probably thought about 3 months, 6 months. But last year with COVID, we saw that how important it was to have some type of cash on hand. Another major issue of cash flow problem is slow paying invoices. And so when I say slow paying invoices, we're saying slow paying customers that we invoice and they do not pay us on a timely basis. That's another major issue that some of the times we need to adjust our terms on the invoice. We may offer discounts to people to pay us right then and there when we provide the service or the product to them. But another major issue is slow paying invoices that our customers do not pay us on a timely manner. Another major issue that we have that causes cash flow problem is high overhead expenses. So generally, we may say, for example, you may rent out a warehouse. And the rent for the warehouse, you have a 10,000 square foot warehouse, and you're probably not using all 10,000 square feet. But you can go to a smaller warehouse to 5,000 square feet. So those are some of the things that we look at as high overhead expenses. Another high overhead expense is employees. You may have employees that you are paying, but is that employee producing is that employee paying for itself? Is it producing enough income for what you are paying that person? So that's another thing that you need to look at is expenses. Another one is excess inventory. We may we may have products that we want to have on hand when a customer order them, but you need to go back and look. Is this item really moving off the shelf on a timely basis? Or is this item I'm using the funds to purchase this item that's sitting there on the shelf for 6-7 months? Should I just order this item when a customer needs it, as opposed to me just holding it on the shelf? So excess inventory is another major issue of cash flow problems. Another major issue is incorrect sales forecasting. We probably, hopefully last year was just a one-time thing, but just forecasting, if you're making your sales, if I made $5,000 last month and I'm using the money and assuming that this month I'm going to make $5,000 again, but I only made $2,000. That can really be a problem, right? That could really be an issue for that. The next thing is employee theft. This is a major, major issue that a lot of companies deal with, is employee theft. Do you have something in place to prevent employee theft? If I have products on the shelf, are they inventory? Is the inventory up to date? Are we keeping with this inventory? That is a major, major problem. So put some type of something in place to prevent as much employee theft as possible. And the last and most crucial thing is bad or no bookkeeping. And so when we say bad or no bookkeeping, if you don't know your numbers, if you don't know your cash flow and how you are operating and what you have on hand, are you overspending? Are you bouncing checks? Are you paying bank fees? Are you paying things like that because you don't know your numbers? This can cause a major cash flow problem. I have seen companies where in 1 month they paid $1,000 in just bank fees because they just didn't understand what was going on, how much cash they had. They were bouncing checks, things like that. So it's so important that you do know your numbers and have some type of bookkeeping system in place if you are running a profitable business. Next slide. Thank you. Now we're going to look at what we call is the cash flow statement. The cash flow statement is a summary of the actual anticipated incoming and outgoing cash in the business over a counting period. You could do this monthly, you could do it quarterly. If you have a fast-paced business, I recommend that you do it on a monthly basis just to look at it, have your accountant, have your bookkeeper send you this report, or if you're doing it on your own, you want to look at this on a monthly basis so that you can budget on a monthly basis, right? You want to be able to know your numbers, plan out your business on a monthly basis. It is so important that you look at this and have this in place. The cash flow statement, it gives you the amount, the timing, how much cash is incoming, how much cash is outgoing, and you can use this for budgeting and business planning. You can use this for invoicing. You can use and think about, okay, my terms on my invoice, shall I shorten the terms for some of my customers? Should I shorten them? What can I do to make sure that I have enough cash running in my business to operate on a daily basis? Believe it or not, if you don't have that cash on hand, it can cause a major headache in your business as you're running your business. Next. This is a copy of a cash flow statement. as you can see on this statement, and everyone, you will get a copy of this PowerPoint presentation, and you will get a slide and a copy of the slide and a recording. So on this monthly cash flow statement, you will see you have cash incoming, you have sales, you have access sales, which is your cost of goods sold, you have incoming that you have any accounts receivable, and then you have the cash that is going out on a daily and basis business. I always recommend that you look at this cash flow statement on a monthly basis so that you can budget and plan for the next month. So you always want to look at this and make sure you have enough cash to operate your business. And I always said in the beginning, you also want to make sure you have enough cash to operate your household, your personal finance, and your business. Because as a business owner, if your personal finance is not in order, trust and believe your business is not going to be in order. Thank you. Okay, so now we're going to go, and I'll tell you, we're going to go over some of the major important business ratios. But the thing is, I'm not, it can get a little wordy and mathematical, but these are some of the basic simple ones that if you are not a person, a numbers person, and your accountant is doing this or bookkeeping is doing your books, they should be able to give you this information. And these are some of the ratios that you need to look at when you are running a business. You can use these ratios if you have a product, and you can use these ratios if you have a service. Because a lot of times, a lot of service businesses feel that they do not need to know these ratios, but you do, because if you have a financial goal and you want to reach that goal, how many hours do I need to put into a client? Or how many clients do I need to see to reach my financial goal, or just to operate my business with a positive number? And so some of the business ratios is you have the quick ratio, we'll go over in detail. You have the current ratio. You have the gross profit margin, I apologize. You have the net profit margin. You have the return on assets, receivable turnover, receivable days, inventory days, and one of the most important is debt to equity ratio. You want to always know what your debt to equity ratio, because this is one of the ratios that the banks look when they're giving you a loan or funding or anything like that. Okay. So we are still all here, right? Okay, on this cold day, right? So the first thing we're going to talk about is the liquid quality ratios. I apologize. These ratios measure your company capacity to pay its debt as they become due. And so, believe it or not, the bank look at these ratios too. So when we are applying for a loan or anything that's out there, grant, things like that, especially a loan, these are the ratios that the bank looks at, because they want to make sure that if they're lending us money, that we are able to pay this money back. And if you know this and you know these ratios, and when you go into the bank or a financial institution, they know you are on top of your numbers and on top of your business. So the quick ratio is you get this information from your balance sheet. The quick ratio is an asset test for estimating at a glance whether your company is facing immediate liquidity problems. So that means, is your business ready? Can you liquidate your business if you need to in an emergency, right? You want to make sure, they want to see if anything happened that you can, if you're facing any of these problems. So the formula is on the far right, which is your cash plus accounts receivable. So that's the cash you have on hand and any outstanding invoices that you're waiting to receive payments for, divided by your accounts payable, what you have to pay out, and any other liabilities you have. This will let them know, this will give them a percentage is your company can handle if it needs to be liquid. The next one is your current ratio. And if these numbers get too complicated, you're going to get these slides. And that's also on the balance sheet. The current ratio is used by bankers to determine your level of solvency. Your current ratio should always be above 2, right? So the banks look at these numbers. They don't tell you. That's why they ask you for all of this stuff, so that this is what makes their decision on whether they should give you a loan and how much loan amount they should give you or finance it, right? So with the current ratio, it's the cash and plus the accounts receivable, right? Plus your inventory and any other assets, current assets that you have. That's everything that you have that you own in that business. And that's divided by the accounts payable, how much you owe out there, how much accounts payable you have to pay, and any liabilities you have out there will give you the current ratio. Even though these numbers seem crazy, even though these numbers seem difficult or things like that, running a business, you need to know these numbers, especially during this time and especially planning out the year 2021 because of what happened last year. It is so important that you know these numbers. The next slide, please. The next slide is giving you your profit ratio. So this tells you, these ratios tell you, is your company able to generate a return on its resources, right? On what you purchase, your cost of goods sold, your time, and things like this. So this is very important. So I want people to understand, even though you have a service-based business, you can still use these ratios because you want to estimate your time, how many hours you're putting into this service. Are you spending an hour on a client as opposed to 45 minutes? What would be your rate on return on those? So don't think just because you're a service-based business, these ratios are not important, but they are important. You can use them as well as a service-based business as well. So the first one is the gross profit margin. This is on the income statement. The gross profit margin is the total sales minus the cost of goods sold, right? The gross profit is gross profit as a percentage of your total sales. This is simple that you can use if you are, and I'm gonna go back to someone, if you have inventory, you know that that's the cost of goods. Cost of goods is what you use. Say you buy an item to produce the item and then you sell that item. That's part of your cost of goods sold, right? Now, if you are a service-based business, you can use this. Say if you use manuals, you print out manuals, you have things like that you need to print, determine. These are items that you're creating to provide your service and produce your service. And so if it costs me $30 to produce a manual, what would be my return on this? How much am I going to charge an hour to provide service to a client? Is this going to cover it take me to print this manual? So it's very important you understand that. The gross profit margin is the gross profit divided by the total sales. It's simple. It's whatever you made, right? Your gross before you start deducting anything. It's the total amount you made divided by the total sales you made. And that would give you your gross profit margin. It would tell you the percentage of your total sales. Very important because this will help you to increase your sales if you need to increase your sales. The next margin is your net profit margin, which is also on the income statement as well. The net profit rate is the net profit as a percentage of sales. This is very simple, another formula ratio that you can figure it out. And this here is just your net profit divided by your total sales. So when we say net profit, we are talking about the gross amount that you made minus your expenses and your net number of that divided by your total sales. This will give you a net profit margin. And you want to look at that because it can help you determine, especially how to price your products and service. It will tell you, you will have a better understanding on if you need to raise your prices. We definitely don't lower the prices, but if you need to raise your prices, this will, or if your prices is okay, it's with the market price, this is what you need to look at and have a discussion with. If you're not a numbers person, you need to have this discussion. I can't stress this enough with your accountant. And your accountant, if you have an accountant, your accountant should be able to understand this and go over these numbers with you and help you plan what your financial goal is for your company. So important, these numbers. The third one to determine your profit is the return on assets. This here is on your income statement and your balance sheet. This is a key bottom line, we call it. We call it key bottom line. This indicates whether your company is effectively generating profit from a given level of asset. So what this does is tells you whether or not the assets that you are purchasing for your company and what you are selling for your company, is it generating enough profit to run your company? Or even let's just say to have enough cash flow to operate your company. And the formula for this is very simple. It's your net profit. And net profit, as we said before, is your gross income minus your expenses and minus your cost of goods sold, right? And your average assets that you have in your company. These numbers, I cannot stress, is so important, and you need to know it. Whether you're a small business, whether you're a large business, mid-sized business, you need to know these business. Even if you're a home-based business, and I always say this because most of the time I run into sole business owners or home-based businesses, and they always feel that these numbers, they do not need to know these numbers, but they do need to know these numbers because I always go back as a business owner, you still need to cover your household bill as well. And you need to show a profit in your business because if you show always a loss on your business to prevent paying taxes, the IRS will eventually say, hey, why are you in business? Is this just a hobby? Or are you a serious business owner? And with today's economy and financial institutions and all of that, it is so important that we show some type of profit in our business. It is so important that we show that in the business. It just makes so much of a difference. And I think a lot of the people, just from my experience, assisted with the PPPs, a lot of the businesses that showed the loss did make money. They missed out on tremendous fundings because they did not show a profit. So, and they base these grants and loans on whether your company can survive or is your company profitable in doing these things. Next, thank you. The next one, this is ratios in determining how well you manage your company. How well do you manage your assets, and how well you manage your inventory? Most of the time, this one covers for your balance sheet. And this is basically for companies that sells products, right? It is so important that you understand how much you have on hand, what's going on. Also, this is accounts your average receivable. How long is it taking your client to pay you, to pay your invoice? If you have net 30 days, if you have pay when services render, that's the best way. That way you can handle your cash flow on here. But so the first one we have is your receivable turnover. This tells you how quickly your company is able to collect on your accounts receivable. And so simpler formula, it tells you how quick you are getting paid, whether it's a product or whether it's a service. It tells you how quick you are receiving this. And this is so important because it determines your cash flow, and it would help you to prevent cash flow problems. And so for the receivable turnover ratio, it's just your total sales divided by your average receivables. And your average receivables is just averaging out how many receivables you receive in a certain amount of time, right? Over your sales. And that number can help you decide whether you want to change the terms on your receivable invoices. Or there may be some clients that you may have and say, hey, your larger clients, if you pay me in a day or if you pay me when we deliver, I'll give you a discount. It'll help because it'll help with your cash flow issues and your cash flow problems. So that's something you may want to consider. That's something you may want to think about. The next one is the receivable days. This ratio measures the average time your company required to collect accounts receivable during a specific time span. So your average receivable, as I said before, is your number of receivables in a certain amount of time times 365 days divided over sales. This tells you on the time, your average time and when you're actually receiving your receivables. So if you are selling products and you do purchase orders and you have people that pays you on 15 days term, 30 days term, this here will help you base on and let you know how much you receive it back on your days on the receivable. The next one, which is so important if you are a company that has inventory, it is called inventory turnover. This tells you how quickly your company turns over its inventory, right? I think this is so important if you sell products, even if you are a restaurant or someone like that. This is so important because this helps you to understand how much inventory you need to have on hand, which I discussed earlier. And so if you understand how quickly the inventory turns over, it would help you plan how much inventory or cost of goods you need to purchase to produce. If I have an item that sells out within 5 days, as opposed to an item that sells out in 30 days, do I need to keep more of the item for 5 days on hand, right? As opposed to the item that sells in 30 days. It takes 30 days to sell. So for this one, the inventory turnover, the ratio is the cost of goods sold, right? That is the items that you purchase, you are purchasing to put together or to resell. If you are putting something together and to resell it, or if I'm buying something at wholesale price and I'm selling it at retail price. So it's the cost of goods sold divided by your average inventory. You want to make sure you keep that number. These numbers are so important. I don't know how I can stress this more. And then you have what's called inventory days. This tells you the average number of days in a specific period between the purchase of that item for resale and when you sold the item. So important. It's called average inventory, right? Inventory days. This is I know like some people, Amazon had took this in, and I think they took it off of some of the people, where the people did not have to store it a long time. They would hold it and process it when people would purchase it. Great theory that Amazon uses. The average inventory days. Inventory days, this formula is average inventory times 365 days over the cost of goods sold. The cost of goods sold is the item that you purchase to resell, or the items or widgets that you purchase to create a product and you're going to resell that product. That's what inventory days is very important. So just to make sure you run an efficient company and you know what you need to have in hands as opposed to what you can hold off on, and to control your cash flow issues, these are some of the ratios that you can use. And I hope if you are a company that has inventory, that you are using these formulas, because it will just help you to run a company efficiently as well. Okay. All right. So now the best one and the last one, which is so important, is your financial leverage. It's called debt to equity ratio. This ratio is so important to lenders, to banks, to financial institutions who is giving you money. It indicates your level of when your company can be resolved. It shows how in debt you are in compared to your equity. This is used by banks all the time, and it's also used, I tell people, your personal credit, your credit, I'm just going to throw this one in there. I get customers that say, hey, I applied at a bank for a loan, they declined me, my credit is great, I don't know why they declined me, I never make late payments or anything like that. But if your debt to equity ratio is high, the bank will decline you just like you had no credit at all, because it's just telling them, will this person be able to pay us back? Does this person has enough equity, or does this person has more debt than they have equity? And if they do, then they're not, where they're going to find money to pay us back, right? And so your debt to equity ratio should be as low as you can possibly get that. And if you bank with an institution, you want to ask that bank, well, what are you looking at? How much do you consider to make me a good candidate? Or even if you don't have it, you always want to make sure that is there when you need it. It's so important that you know and you keep the debt to equity ratio low. You want to build your equity. It should always be higher than your debt, and you want to keep it as low as possible, because even though you may have good credit, great credit, excellent credit, but if your debt is higher than your equity, the bank will definitely tell you no. They feel that you will not be able to pay them back. So it's just so important that this debt to your debt is lower than your equity, even in your personal credit as well as your business credit. It is so important to have that. Okay. All righty. So with that, the thing is, do you know your business number? Have you talked to your bank? Have you had these discussions? Have you had these discussions with your accountant It's so important that you know these numbers. And I always want to say, keep this in mind, even if you are an at-home business or you a one-person business and you a small business, mid-sized business, these numbers are just as important, whether you're providing a product, whether you're providing a service. Because if you have a service, you want to make sure that the time you're spending, right, with a client, that it is paying, if it's enough to pay what your time is spending or averaging out. So you want to keep that in mind. You also want to keep in mind when you're running a business, always consider your personal finance as well. So when some people say, oh, what is my budget? What is my business budget? You also want to keep your personal budget in there. If you're not working a second job, or if you're not working a job and this is your only source of income, you want to make sure that this business is operating and is covering you personally and business wise. And also, if it's covering you personally, that personal budget, your bottom line will show that you're showing an income in the business, and that's a benefit. And that's what the banks and the financial institutions would love to see, that you are a profitable business. It is so important. Okay, so now we're open for questions. If anyone has any questions, I'm here to answer them. And I believe I can see them in the chat, or Miss Bell will assist me with that.
Yes.
Okay. Okay, is there any questions anyone have? Was everyone clear on everything that was happening? Was anyone, was it too many numbers here? So I would like a little bit of feedback. As a business owner, how many of you have considered these ratios or have spoken to your accountant or thought about these ratios as a business owner? Okay. Yes, Carol. Yes, so we will send you, I believe I sent one over. You can use a Excel, Carol. Instead of, it's better to use the Excel so you can put it on and include a formula for that. And we will get one of those over to you, and Carlos as well. Yes, so we will make sure you get a cash flow statement that you can just open up and use that as going forward. It would be great to use, and so we would definitely make sure you get that. Is there any other questions? I'm looking. Yeah, we have a template, Carol. It'll be an Excel spreadsheet that we will use. I will send that over to you for the formulas on the cash flow statement. And I can't stress it enough. I don't know how many in here is a service-based business, but you want to make sure, even if you're a service-based business, you can use this as well. Okay, hi Joanne, how are you? So, Joanne, we will provide that information. I believe it's at the end of here it is, Joanne, there it is. So that's the information. You can get one-on-one consultation if you need additional, or if you do not understand some of these formulas, because they can get a little cumbersome when you are if you're not a numbers person. But if you're not, you need to take this and ask your accountant, what are your ratios, and you need to plan and schedule this, especially for year 2021. We don't know what it's going to bring us as small business owners so that you can properly plan your year out correctly. Are there any more questions? Okay, hold on. I'm trying to look at the chat here. Okay, so Carol says she never really thought about the ratio. Very important. Will you receive something? Oh, yes, the ratio be included in our business. Yes, you can. So Carol, yes, you are going to receive this entire PowerPoint presentation. Rutgers will send this to you, the entire PowerPoint presentation. And yes, because I say you should use it in your business plan because it will help you or give you an idea. If you have an idea of what your beginning financial goals are, and you have this in your business plan, when you're presenting this to whoever you're presenting it to, it is much clearer and they know you are serious and understand the numbers in your business. So yes. Thank you. Dominique. Thank you. Dominique said he's a lender. See, we have a lender. Hi, Dominique. And this was great. We use these ratios. See, they do use these ratios to determine your company credit worthy. So it is very important that you do look at these ratios. And thank you so much, Dominic, for mentioning that the bank definitely, or lender, that they definitely use these ratios. These are some of the basic, simple ones, but I think everyone should get familiar with them. And when you present that to the bank, to a lender, they know your numbers are more serious about your business. It makes so much of a difference. Yes. Thank you, Dominic. Any more questions?
Feel free to ask your questions. Take advantage of this time.
Yes. On this cold day, like it's cold today. Where are we going, right? It is freezing out there today, but I'm okay with the cold instead of the snow, so that's fine as well.
We do have extra time, so if you have any questions, feel free.
Does anyone else have any questions? Okay.
So if we don't have any more questions, I would like to thank you, Mary, so much for this informative presentation and for your time today.
Thank you. It's been a pleasure. It's always a pleasure. If anyone has any additional questions, please feel free to reach out. So Carlos said, do you have a recommendation for a business banking? So I don't have a specific bank to recognize with. I think we had Dominic on here. He's a lender. I don't know if he was from a bank, but my question is, Carlos, you need to, and each and every one of you on here, it's so important that you build a relationship with your bank, a local bank in your area. I cannot stress this as I can. If it's a bank that you do have your business account with, you need to build that relationship with them. It's so important. So Dominic is here. And they're a great bank, which is M&T Bank. Dominic, I'm with M&T. Yes, relationships are key with your banker. So I guess Dominic is on there. He is a bank, M&T Bank, which is an awesome bank for business owners. You can reach out to Dominic. I think, Dominic, you would probably have to contact Rutgers, and they can provide your information as well. Just make sure that you all build some type of relationship. And I tell you, to be honest with you, During this COVID and PPP, I had assist so many clients with the PPP, and because I had a relationship with a bank, it just made the process so much easier. The bank was just helpful. So it is so important. I can't stress it more than enough that you should all have some type of relationship with a bank. Definitely your local bank. You want to go in there, open up an account. That was so important with the PPP, which is open now. They're accepting, but most of the requirements is that the bank that you have or some type of account with them. So it is so important that you do build a business relationship.
Okay, so thank you again, Mary. I know we
Mhm.
all walked away with some very important information today.
Thank
I want
you.
to redirect you guys, everyone, to the chat. I am posting right now some of our upcoming webinars, as well as our Eventbrite page and our actual website. And going to these links will either have you to register for a webinar, or you can always visit our website to request counseling as well. So I also want to remind everyone that after the webinar, you will be receiving the video replay as well as the presentation slides in 48 to 72 business hours. So you can always refer back to this information. And after this webinar is over in the browser, you will see a pop-up, a survey pop-up. I would really appreciate it if you can take a few minutes just to complete that. It will really help us to adjust our presentations as well as give us some information on what kind of assistance you may be needing. So if you have extra time to complete that, your feedback is very much appreciated. And on that note, we will now end this webinar. I want to thank you all for taking the time out to attend today, for participating, for asking your questions. Thank you again, Mary.
Thank you. It's a pleasure always.
Yes, and we look forward to seeing you all at our future webinars. Have a great day, everyone.
Thank you. Thank you.
Thank you.